push the recording button. Now I did. Special thank you to Yash, who got up really, really early in California to do this talk. Yash, thank you so much for coming, and we're all looking forward to the presentation. Please go ahead.
Thank you so much,
Sorry,
Yes.
one quick thing. Sorry, I'm too excited, so I forgot. Yash doesn't mind if we interrupt him at any time with questions, so please just raise your hand, and we'll try to get those questions answered. Now I'm done. Yash, thank you.
Wonderful. Thank you so much, Andre. Thank you so much for the opportunity. It's a privilege to be here, and I'm really looking forward to all the feedback. This paper is, I think, very much work in progress. We need to do a lot of other interesting stuff, I believe. So any comment is very, very welcome. So joint work with Zida, Peter Dixon, and Junbo Wang. So before I get into anything, because Peter is with the SEC, I have to display this disclaimer. This is not reflecting the SEC's views or the commissioner's views. Okay, so let me get right into this. I don't think there's any dispute with this audience that institutional investors form the most important investor clientele. There is tons and tons of research on how and why these investors matter. They own the vast majority of U.S. equity. They provide liquidity. They have an impact on price efficiency. Their presence affects corporate governance. It shapes product market competition, and it even has links to accounting practices. Well, so these are important investors. Now, why does it matter? Well, one thing about institutional investors' data is that the only reliable and official source that we have for institutional ownership comes from the 13F filings, which are filed quarterly. Now, it's probably plausible that a lot of research questions that might want to understand the roles of institutions might require high frequency data, for example, daily data. So in the literature, we have come up with different solutions for this problem. For example, one solution that has been fairly common, at least for some time, was to basically look at large transactions from TAC data, then sign them into buy and sell, and then say, look, these are large and probably reflecting institutional trades. So let's look at the imbalance between these trades and then use that as a proxy for institutional trading. And then that will give us some insights about how these investors trade at higher frequencies. Again, for this audience, I don't think it would be much of a debate that with all the changes in equity markets, the order splitting, midpoint trading, the latency issues, the algorithms underlying this sort of proxies are probably problematic. The other solution that we often went to was try and use actual institutional trades, and the go-to database has been the Inferring data, right? So the issues with Inferring data are its own. So first off, no more academic access are granted, no new subscriptions are provided. The coverage of the data is somewhat modest. So there are different estimates, but I haven't seen anything beyond 12, 13% of the entire trading volume in crisp data to be covered by Inferring. And also the data only covers pre-2015. So, and you also could argue that there could be some sort of selection biases as to like some institutions do not even report to Inferring. So with this, basically, we try to, in this paper, propose a proxy that is not subject to these issues. So what's the basic idea of the paper? So what we started observing was institutions routinely make their stock holdings available for lending. And in fact, when you look into the institutional details of the security lending market, in particular on the equity side, the main suppliers of security loans are investment firms, pension funds, and endowment funds. And in other words, they are the main group of institutional investors that we care about. So the other interesting feature about the security lending, in particular, the security lending supply, is that this supply is pretty inelastic to lending fees or the prices. So basically, the variation is not likely to be driven by prices, which makes us feel like, okay, the variation is probably because the ownership is changing. So as a result, the amount that they're making available is changing. So that's another observation. And in fact, consistent with this, when we look at the ratio of lendable equity divided by the total number of institutionally owned shares, which we refer to as L ratio here, we find this ratio is very strongly autocorrelated over time, very stable at the stock level, which is an indication that we're looking at something promising here. So there is this database provided by S&P Global, S&P 500 Global, formerly known as Market, that provides estimates of lendable equity on each firm. So there are several nice things about these database, but the ones that I find most useful is that one, the data covers up to 95% of the NMS listed equity, depending on which year you're looking at. In the earlier years, say in 2007, 8-ish, we're looking at about 80%, but as you get closer to the more recent years, it surpasses 90% coverage. And based on what they claim in their marketing statements, all the major security lending programs share data with markets. So this is sort of a gift to get access model, where if a security lending program would like to have access to market data real time, they should be providing data. So that creates an incentive for everybody to contribute to the extent reasonable. And then when we actually looked at the user's manual of this database, there was this statement that sort of jumped at us where it says the supply slash lendable equity that they estimate can be used as a high frequency proxy for institutional ownership. And talking with some practitioners, we found out that at least a group of practitioners view this to be a reasonable high-frequency proxy for institutional ownership as well. So bottom line, we're going to use the daily changes in lendable equity, which we scale by that L ratio thing that I explained earlier. So I'll get into why we do this scaling, to proxy daily changes in institutional ownership at the stock level. So basically, that's the idea. So here are some relevant institutional details that might help interpreting our findings. So the first point is that institutional investors can have no more than 1/3 of their overall holdings on loan at any given point in time. So this is not applied at a security-specific basis. This is applied to all the holdings. So what it means is that the amount that they make lendable naturally cannot exceed the 1/3. And quite interestingly, we see that also in the data. The share of lendable equity to institutional ownership is about 35%. And that has been shown by others before us. The other piece of institutional detail here regards the settlement timing. So for security loans, settlements happen on the same day, but with equity trades, settlements have 2 to 3 days of lag. So what this means is that if you want to understand when institutions trade, by looking at the changes in a lendable equity, we need to always shift the dates 2 or 3 days backwards to get the timing right. So that's another piece of information that is important. So the third and more general piece of information with regards to institutional details, it is that security lending market is highly segmented. So we have a quote unquote retail segment and a wholesale segment. So the retail segment does not refer to retail investors lending or borrowing. It basically refers to what brokers do internally when they facilitate short selling of their clients. So essentially, for example, you can think of Virtue um, catering some security loans to some short seller client, and they basically take, for example, holdings of other customers. They could be retail investors, right? To basically back out those loans. Now, Virtue can end up with situations where the demand for loans exceeds their holdings, right? And in this case, they will have to go somewhere else for clearing. And this somewhere else is what's called the wholesale section or segment of this security lending market. This is an interbroker section. The demand side in this section is basically brokers and very large hedge funds. But the supply in this segment comes primarily from institutional investors, the ones that I listed earlier. And normally the supply is offered through custodian banks who basically run the security lending programs and take care of the details of security lending. So what market data provides is this last supply down here, and that's why we think that it's a good database to go to understand institutional trading. So
Yash,
yes, I see.
there
Yes.
there are some comments in the chat that I figured we could pause for. Jim, I'm not sure if you want to unmute and just ask.
Okay. I thought the 1/3 limit on institutional holdings only applied to mutual funds because it's effectively leverage the way the SEC views funds. So does it also apply to endowments and pension funds?
Hi, Jim. So I believe it is stemming from the Investment Company Act, right? I forget which year it is, and I believe the coverage of the regulation, or at least the language used, is pretty general. So it says investment company. So as a result, we believe it applies to all the investment companies. We have seen other studies citing that, but we're more than happy to look more carefully and make sure that this is true.
Yeah, because I don't believe a pension fund or a university endowment qualifies as an investment company under the Investment Company Act. And likewise, hedge funds, by design, do their best to avoid being classified as an investment company. So I suspect they would not be subject to the limit either.
That's great. That's really important to know. So I'm going to definitely look into this. Thank you so much, Jim.
Dmitry, I think Yash spoke a little bit about retail. Do you want to?
Yeah, very quickly. So I think the idea of using lendable shares as proxy for institutional ownership is very clever. I just kind of trying to understand what's behind those lendable shares in market. For example, we know that retail brokers like Robinhood, TD, they make a lot of money by lending their shares. So is their lendable supply part of market lendable shares? And what about other types of investors?
Thank you, Dimitri. So I don't think that as a general rule, the holdings of individual investors would show up in market data unless the brokers run some sort of a lending program that shares data with market. So our understanding is that much of the interaction between individual investors and short sellers happen at the intra-broker or the retail segment of the market, and the market data does not provide any information on that front. So everything, we believe almost everything should come from institutional investors on the supply side of the wholesale market, if that answers your question. Very good, thanks.
I want to follow up on that because I know for sure, like Interactive Broker, they have the share stock lending program. So that might show up in market, right?
Hi, PK. It might. We probably need to look into this more carefully. So the hope at least is that even if brokers run such programs, the amount that they make available is going to be small. But then suppose it does show up in markets data, it's going to add noise to our measure. So to the extent that we're going to use, say, 13F data as the benchmark to basically look into the performance, inclusion of such data should worsen the performance of our measures in the tests that I'm going to show you. But I agree. This is something that we need to get to the bottom of it. And thank you for mentioning the interactive brokers.
Looks like we're good to continue.
Very good. So yeah, so basically this is a summary of the paper. So what we think we're doing is that we're proposing a new proxy of stock level daily net change in institutional ownership, right? So it's important to understand that this is a net change in institutional ownership, not the levels. It's not subject to the limitations that other proxies face. So hopefully that's good. And we show in the paper that our proxy better tracks quarterly changes in institutional ownership that we obtain from 13F data. And we do that by comparing our proxy to 3 existing proxies out there, with the benchmark being the changes in 13F reported institutional ownership. We use a host of functional forms to get at the association between each proxy and the benchmark. And we show that the superior performance of our measure obtains both in and out of sample. We then use this proxy in several applications that I hope to talk about 2 of those today, should I have enough time. All right, so just very quickly on the data, our starting point is NMS listed common shares on CRISP 2007 to 2021. We also require a bunch of data from other data sources. So whenever the other data is not there, we're going to basically get rid of observations. We also merge with Inferring for the period that we have access to. And then we apply a bunch of basic filters to get rid of outliers. So eventually, our collective sample is going to be 19% of what we initially started with. Sorry, about 80% of what we initially started with. Okay. So how do we proxy the net IO change? So first off, we're going to adjust both institutionally owned shares as well as lendable equity by the previous quarter's shares outstanding, just to make sure nothing funny happens with the number of shares outstanding that could affect things. And then we are going to, in our baseline, assume a constant elasticity of institutional ownership with respect to lendable equity. So basically, as a result, our proxy is going to divide the change in lendable equity over a given period. It could be a day, could be a week, could be a quarter, by the L ratio from the previous quarter. So this basically brings in the constant elasticity notion. So that's our measure. And then we have three alternative proxies here. The first one is the imbalance in BJZZ trades with the premise that, well, BJZZ picks up retail trades, so what's not retail is institutional, so minus BJZZ imbalance is a proxy. We all know there are caveats to this, but for some reason, the literature still likes using the BJZZ as a measure of retail flow, so we're going to keep that as one of the proxies. The second one is the actual trades that we get out of Inferring database. We're going to look at the imbalance between buy and sell institutional trades. And then the last one is the more traditional proxy where we go to the TAC data, we take trades whose value exceeds $50,000 and then sign them. The imbalance of those is going to be the proxy. For all the proxies, we're going to divide the imbalance by the number of shares outstanding at the end of the previous quarter to basically normalize everything and make them comparable. So I believe there was a question, so I'm going to see what that was. What are the limitations of quarterly filings being used as a benchmarks? So Mehran is asking about the limitations of the quarterly filings as a benchmark.
If I may elaborate, what I had in
Sure.
mind is that so you're basically looking at 13F and see what your measure is doing in comparison to the other measures when predicting the changes in institutional ownership, and the data that we have that seems to be the most reliable one is the quarterly reports. And I was wondering, since at the end we want to use your measure for higher frequency data, how actually using the quarterly, how much we can trust that as a benchmark.
I think that's a fair point. So I guess you can talk about problems like window dressing or the temptation to obscure holdings by institutions because they do not information to come out, or in very pessimistic ways, manipulation incentives. I think all of those are possibilities, but does that mean that we cannot use the IO? Probably not. We eventually need a benchmark, but I would be very happy if we could find with some other benchmark to examine our measure against. But I guess in the end of the day, what we're proposing is a proxy. It's going to be subject to errors, and maybe one of the errors in the proxy would be stemming from the fact that we're using a benchmark that itself is subject to errors. But thank you for the comment. PK.
Yeah, one more proxy you might want to consider is simply the negative of the short interest, because typically when an institution is buying, I think the short sellers are the one who are selling. Or also, this might be weaker. The next one is negative of the insider holdings, because they may also be selling, and then the natural buyers would be institutional traders.
Wonderful. So negative of short interest. So you're thinking the biweekly FINRA reports, right?
Yeah.
Awesome. This is a great suggestion. Thank you, PK.
Sean, would you like to unmute and voice your comment?
My understanding of the market program is that it's sort of a give to get program, which the largest lenders who can do things by themselves don't necessarily contribute to, because they give up a lot of information but get relatively less in return. And I thought this was partly the purpose of the security lending rule from the SEC.
I cannot argue with that. So, I mean, market claims that they cover about 80% of all the globally listed securities, right? And then to the extent that there is some correlation between institutions trading the same thing, I mean, it's reliable. But yes, it's a give to get. So the give to get creates some sort of a trade-off, right? So if you don't contribute, you won't have access to either. So Yeah, again, this is a proxy. This is not going to be the measure of institutional ownership. This is just a proxy for high frequency changes in institutional ownership. And there's all sorts of issues you can talk about when you're evaluating a proxy. I agree. Okay, so Stephen.
Yeah, one question, well, two questions. One is related to the short interest. I mean, you're using the lending data. Actually, DataLend actually has more data than market, but I don't know about their ratios. But the other question is, when you're using the BJZZ, are you also trying to determine for midpoint trades direction? Because most of the, or a huge amount of the ATS activity is done at midpoint.
I think that's a great point, Stephen. Yeah, I mean, we understand like there are multiple issues with the BJCC. You know, I wrote a paper on it, and the reason we're using it is that like people out there still are using it. So we thought, well, let's throw this in. But it's just an alternative. So we're not going to rely on it for any of the, you know, applications or eventually it will not be the sole source for the validation. And regarding the use of market versus the other two sources of secure lending data, we believe the shortcoming of the other two providers is that they do not provide a direct measure of lendable equity. So if you were to estimate the lendable equity from what they provide, you would have to take the utilization rate, and then you would have to take the shares on loan and then divide the shares on loan by utilization rate and to get the lendable equity. What's the issue with that? The issue is that both of those variables, utilization and shares on loan, are reported as an average that is calculated across all the contributors for a given securities, and we have no clue how that's weighted, right? So you could get very crazy numbers for lendable equity. Market provides an estimate of lendable equity on their own. So, and we believe that they have their proprietary way of coming up with that estimate, which hopefully takes into account the weights and the size of different contributors that shape the average utilization and shares on loan data as well.
Thanks.
Yep. All right. So moving on. Oops, I went too far. Okay. I'm going to start with the in-sample performance of the measure. So here what we're going to do, like I said, we're going to take the 13F changes, institutional ownership changes from 13F as the benchmark. And we're going to estimate a very simple model. So it's a linear regression, single variate, where we regress standardized changes in institutional ownership on standardized proxies, right? So one at a time. So we have 4 proxies. And our measure of goodness of fit is going to be this a little b coefficient, as well as the adjusted R-squared associated with these regressions. We try both panel regressions with fixed effects as well as the Fama-Macbeth. So these coefficients represent our estimates of little b. So as you can see for our proxy, the coefficients are remarkably larger in magnitude, even though all the coefficients that we estimate for all the proxies appear to have the right sign. But in terms of goodness of fit, we find very clear evidence that the in-sample performance of our measure is significantly better than the alternatives. So I mentioned that we're making an assumption about the elasticity of institutional ownership to lendable equity being constant. So we revisit that here, thinking how realistic this is. And to do it, we're going to condition our estimate of the goodness of fit that I just showed you on certain group of characteristics. So we have characteristics that have to do with security lending, starting from the L ratio, the utilization rate, and the average tenure. So these two would reflect the activity in lending. So higher utilization rate and lower average tenure would mean that the lending is more active. Then we also look at institutional investor level characteristics, concentration using the number of owners and Herfindahl index, as well as the level of institutional ownership, as well as a bunch of key stock characteristics. All we're going to do is that we're going to split the sample or each cross section into above and below median segments based on one characteristic at a time, and then fit our model using a Fama-Macbeth regression. So here I'm showing you how the coefficients differ, or whether they do, when we condition on low versus high characteristic X. So we do find some variation in the goodness of fit, which sort of suggests that we might want to allow for a variable elasticity in our analysis, which we will do in just a little bit. Okay, so, and we mostly do it in our out-of-sample performance. So I'm going to move on to the out-of-sample performance. So for this, we are going to estimate the relationship between the changes in institutional ownership and the changes in lendable equity over a 20-quarter period. We're still focusing on quarterly data. And then we're going to skip one quarter, quarter Q, go to quarter Q plus 1, and then use the functional form that we have estimated using the training sample, if you will, to form predictions of changes in institutional ownership. Right? And then eventually we're going to examine the correlation between the true change in institutional ownership and the predicted change in institutional ownership in quarter Q plus 1. We do it for all quarters where this is feasible, and then calculate the average adjusted R-squared or correlation across quarters. Okay, so that's basically the procedure. Now, in applying the procedure, we first use the unconditional approach, so simple OLS, simple regression, where we only use one of these proxies as the explanatory variable. Then we go to the conditional OLS framework. This is informed by what I showed you just before, that said, you know, this elasticity should be variable. So here we're focusing on lendable equity only as the proxy, and then we allow the elasticity to vary with characteristics that I showed you earlier. And then we said, hey, why don't we go even further? Why sticking with OLS? We can just allow machine learning to pick the functional form that the elasticity takes in these characteristics that we're using. So then we're going to allow different machine learning algorithms to pick the functional form and fit the elasticity function before we multiply it by DLN to estimate the change in institutional ownership. All right. So, so here are the results for the baseline out-of-sample performance for the 3 alternative proxies. So, for example, if I focus on Inferring institutional flow as the proxy, the out-of-sample performance is quantified by a predictive average R-square of 5.8%, okay, based on that simple linear regression that I showed you. Now, if you go to our measure, all of a sudden, the predictive power, in my opinion, rises to an impressive level of about 14%, okay? Now, we saw that the elasticity should be varying with characteristics. What happens if we relax the constant elasticity assumption? If we do that, the R squared jumps to about 18%. So there is a little bit of improvement when we allow variation in the elasticity. What if we go even all the way in and allow machine learning algorithms pick what functional forms fit the data best? So this is where we sort of hit the wall with, oh, the machine learning could overfit outliers. And we didn't get as much out-of-sample performance unless we started cutting outliers from each cross-section. And then it turned out that we only can beat this 18% predictive R squared from the conditional OLS model by trimming about 10% of the data, 5% at the top and 5% at the bottom tail. And this result is really independent of what algorithm or what group of algorithms we employ in our machine learning analysis. So overall, it seems like we have a good set of evidence that our proxy does a decent job in matching the changes in 13F IO. So with the caveat that 13F IO might not be the most accurate thing out there, but also observing that's the only thing we have to go to. Okay, so next I'm going to show you two applications. So it looks like I have about 10 minutes, I think. Well, maybe I could pause here for questions if there's any, actually. Okay, doesn't look like there's questions, so I'm going to move on.
Well, I do have a
Yep.
question.
Sure,
So
PK.
what's the point of this estimate? I mean, are you saying these are informed institutions or they may be uninformed indexers, right? I mean, unless you
No,
distinguish
that's a
between
very
the two.
good question. That's actually a comment we have received last week as well. So like basically the nature of the comment is we want to understand whether there is heterogeneity in the type of investors that participate in the lending market. And as a result, whether our measure picks up, certain institutional investor activity than others. I don't have an answer for that, but we plan on working on it. And the idea is to basically condition our analysis that I just showed you, especially the in-sample, on the type of institutional investor that dominates the ownership at the stock level. There are two sources for that. One is the Agarwal paper, and then Boucher also has classification. So we're going to go there and then see whether the goodness of fit varies with the intensity of different types of institutions owning the stock. Does that answer your question, PK?
Thanks. Yeah, as you said, you may explore further, right? So I'm curious what you find.
Yes.
Thanks.
No, this is a great point. Thank you so much. Peter.
I want to mention that if you trim or truncate 2.5% with your machine learning algorithms, the explanatory value of the algorithms are exactly almost exactly the conditional regression. So it probably suggests that your machine learning algorithms select exactly the same function as you fitted in the conditional regression. Don't you think so?
Sure. Yeah, no, it could be the case. I'm not saying that it is not. So the point was, like, we won't get anything better unless we start trimming really
I understand it perfectly.
Yeah.
But it would be interesting if the machine learning algorithm will figure out the best approximation you could figure out yourself. Sorry.
Yeah. I guess that would be interesting. I think that's something we could look into possibly and maybe report for those who were interested in the use of machine learning and this stuff. Thank you so much. I'm going to take that down here. Very good. Okay, so I'm gonna try and show you two of the applications that we perform using this measure. The first one is on long-term return predictability that might also have to do with the institutions being informed comment from PK. So the premise we start with is that institutional trade reveals fundamental information. I mean, to the extent that that's true, then you would think that market participants might interpret past price signals differently, depending on whether the past price signals agree or disagree with the net change in institutional ownership. Okay, so let's keep that in mind, and then I'm going to walk you through what we're doing here. So just to remind you of your empirical asset pricing PhD courses, we know that if you construct portfolios of past returns from month, say T-12 to T-2, skip 1 month, and then look at the profitability of this trading strategy, we see significant risk-adjusted alphas in month T, okay? So fact or observation one about this momentum comes from a paper that I was very lucky to write with Vincent and Dimitri, who I believe are in the audience here, where we show that the momentum strategy only works if you construct portfolios of past returns using past intraday returns. So if you just focus on past overnight returns, you don't get anything. So this is observation one. And that's a whole paper and a lot of analysis going into what derives this result, which I'm not getting into. Observation two is that institutional investors primarily trade intraday. So now there is some sort of synchronicity between the source of the momentum profitability and the institutional trading in terms of things happening intraday. So what we're going to do here is to try and refine the result that I just showed you in some way. So we're going to basically construct portfolios of past intraday returns, right? Same horizon. But we're going to basically decompose the signals into two mutually exclusive sets. So one is where the sign of intraday return is the same as the sign of the change in lendable equity. In other words, net institutional trading aligns with the contemporaneous intraday price change versus the signs of the two variables oppose. So institutional trading goes in the opposite direction. And then we're going to compare the three-factor alphas that arise based on these two portfolio formation routines. And the premise is going to be that if market participants underreact to past price signals that oppose the net institutional trading, then we should have momentum, right? So like participants could be placing lower weight on signals that are not associated with contemporaneous institutional trading. So here I'm basically showing you, let's focus on this part of the table. So I'm showing you portfolios 1, 5, 6, and 10. And then we have two versions of those. One is where the intraday signal has the same size as the change in lendable equity, and the other one where the signs oppose. So when the signs align, we do not see any profits associated with the momentum strategy. Whereas when the signs disagree, we get this significant risk-adjusted alpha. So there is some evidence that might suggest the underreaction is what's going on. For example, when you look at the intraday return that we use for portfolio composition or construction, the top versus bottom difference is only is of 123%, whereas when the signs of the intraday and the change in lendable equity differ, that difference is much smaller. So basically, it seems like that there is some sort of there's a situation where the prices do not adjust quickly when institutions are trading on the opposite side of the price movement. And because of that, you could get some underreaction. Of course, this is one interpretation. You could also think about, hey, institutions could be informed. Their information is long-lived, so they are in no rush. So they're going to time their liquidity consumption and basically build positions when the price is moving in the opposite direction. But because they have information, that information is going to get revealed in the future, and we will see this underreaction-like result, and as a result, the momentum anomaly. So that's the first application. The second application I wanted to show you would look at the trading of institutions around earnings announcements. So this basically is motivated by this literature on earnings announcement premium. So we understand that prices or returns tend to get more positively correlated around earnings announcements. So there has been quite a few papers on this trying to offer both rational or behavioral explanations for why this happens. And we thought that with this proxy for institutional trading, we might have an opportunity to get more about this. So what we're going to do is we're going to basically take about 90,000 earnings announcements and over this time period, and then examine the proxy that we propose over a 20, or I should say 21-day window around announcements, and look at how the averages of our proxy behave around the announcements. So DiMaggio and co-authors have done a similar exercise using Inferring data. So that gave us a very nice benchmark when we learned about it after we wrote the paper. But I guess the fact that we have consistent results with DiMaggio and co-authors is pretty encouraging. So basically what we find is that the proxy of daily net institutional trading appears to drop significantly the days prior to an earnings announcement, and then it jumps up afterwards. So basically, it feels like institutions tend to unload a bunch of their positions before the announcement and then recover them or reestablish them afterwards. So regardless of what the reason for this is, DiMaggio et al. Get to explain what the reason could be. This pattern basically says that if there is price pressure associated with these institutional trades, you would be seeing increased commonality in prices as the selling pressure before the announcement pushes prices down, and then the buying pressure after pushes the prices up. So it's going to create this increased commonality, which the literature documents as increased market betas and so on. So essentially, we are providing some form of a trade-driven evidence for a trade-driven reason why the earnings announcement exists. And you could interpret this in different ways. One of the ways we try to interpret this is that investors are trying to avoid the risk associated with the exposure to the announcements. So they sort of reduce their exposure before, and then after the risk is reconciled, they re-establish the positions, and that's why we get this result. Okay, so let me go to the conclusion. So we believe that changes in lendable equity proxy the changes in institutional ownership. We provide evidence that it does, and it does from 13F. We show that our proxy outperforms existing measures both in and out of sample using different estimation methods. The merit of this proxy is that it comes from the data that is readily available to researchers, which is not the case for some of other proxies. And then we use the proxy in different applications, two of which I showed you. The other two that I didn't look into, the short-term return predictability based on the premise that institutional trading has temporary price pressure that is followed by price reversal, and also the trading of institutions around stock splits. And we find some evidence that institutions basically become market makers as the clientele of investors changes around stock splits when more retail investors jump in and want to take positions in that stock. Okay, that's my presentation. Thank you very much for all the comments and for listening to me. And I look forward to any additional comments and discussions that there might be.
Thanks, Yash. Folks, just as always, raise your hand and we'll just go one by one. Mehran?
Yeah, I was wondering, so you're looking at the, you might have mentioned it, I might have missed it. You're looking at the change in lendable equities. And so one reason is the change in lendable equity might be a result of change in institutional ownership. But I was wondering what are the other possibilities. One thing that I can think of is short sales, actually. That might, if you have more short sales, that means investors are borrowing those lendable. So there's, I'm not sure if that is taken into account in your measure. And what are some other possible events that can result in change in the amount of lendable equity?
Thanks, Mehran. So I don't think I can give you like all the other possibilities that could drive changes, but I'm pretty sure that the changes in shares on loan does not drive the variation in lendable equity. So I guess your takeaway was that we're looking at the excess supply of shares, but that's not the case. We're looking at the entire pool of shares that are being supplied. Some of them are on loan, some of them are not. So these two variables are not connected. So basically, one is the denominator for utilization rate, if you will, and it only reflects how much the provider, the supplier, is making available for lending. There could be other reasons why this changes. We haven't gotten to the bottom of what exactly drives other possibilities besides changing in the ownership itself.
Thank you.
Yash, while we're waiting for questions, if they will come, do you have any fun things in those extra slides that look plentiful?
Okay, yeah. So I guess one thing I wanted to show, I mean, here's an example of how the change, well, I guess I can go to the previous, right here. So here's an example about the timing of the changes in our proxy around some form of shock that we know is not information driven. So these are index reconstitution dates. So we're looking at this particular stock, the Genworth Financial Incorporation, in the 2016 reconstitution. So the stock moved from Russell 1000 to 2000. So basically, it is moving from the very bottom of an index to the very top of the other index. So you would expect that institutional ownership would go up. So that's exactly what we see. And of course, this is overestimating the true change in institutional ownership because reconstitutions tend to sort of focus on what passive investors are doing. So we have also active institutional investors whose trades are not necessarily reported here. Nevertheless, when we look at the and then the next slide is basically showing the timing in terms of the settlement gap. So when we fix the settlement gap and adjust for it, the rise in institutional ownership happens exactly on the reconstitution date. So before I get to Anna's question, I just wanted to show you this, and that's the average institutional ownership based on 13F around the reconstitution dates. So we see that when firms go from Russell 1000 to 2000, there's an increase in institutional ownership, like the picture that I showed you. And when it's the opposite, switching from 2000 to 1000, there's a decrease. So the reasoning or the logic is the same, but the point is the picture that I showed you here probably overstates the true change in institutional ownership. So this is one thing that I thought would be sort of interesting. Anna, sorry, go ahead.
No, awesome. Thank you so much. I was wondering if your measure has any sort of information about the informativeness of this order flow that you're picking up on. Generally, we think that, well, institutions are informed, and you spoke a little bit about it with this short-term price predictability, that you see price reversals, which would be the opposite. So I'm a little bit curious about learning more about that. If you have any results, that is.
No, this is great. So we actually did look into it. Yes, in the short term, the only dominant thing that we can get out of this is the price reversal or a negative return predictability, which is consistent with the price pressure story. I guess an alternative interpretation of what we find with regards to momentum may have to do with informed trading. So basically, the mechanism there would be that you have institutions that possess long-lived signals, right? So they want to trade on it. So the signal is going to realize in the next year or something. They are in no rush for trading. So what they do is that they're going to time their liquidity. They will very slowly get in when the prices are moving in the opposite direction. They save on trading costs. They get their positions. They build their positions that they want. And then we see future return predictability in terms of momentum. So the only thing that we have in terms of something that can be interpreted as informed trading is this one, but I'm very open to any ideas that anyone could have to try and see if there's more.
Thanks.
You're so welcome.
Yes, I apologize. My connection is bad today, so you were breaking up a little bit. Did you say that you think that the institutions you're picking up are long-term traders? Or trade on long-term information, trade sort of passively?
Yeah, we haven't put that in the paper, so I'm just saying this is an potential alternative explanation for why we find this momentum result, right? So it could be, I'm not saying, I mean, some of them could be long-term investors. I'm not saying, I mean, the hope is that we have, roughly speaking, a homogeneous group, not homogeneous, but roughly representative of the true composition of institutional investors. And the proxy is meant to show the net change in the entire set of institutional ownership, right? So I don't have a good answer for what type of institutions we're picking up. Like I tried to explain earlier to one of the commenters, I think it was PK's comment. We plan on looking into the institutional investor types that primarily hold a given stock to see whether that aspect could shed more light on why we get to explain the changes in institutional ownership from 13F. And if it does, then we might have some information on what type of institutions we're actually picking up with this measure.
So just two very quick thoughts. One way to try and understand what kind of an institution this could be is to look at dark trading. I think Jonathan Brugart has, one of his studies says that long-lived information often goes in through dark trading. Awesome. And then I thought that Dmitry was going to bring it up, but Dmitry's ITI metric has a what I tend to think of as a long-lived information version that could also be tried. And then there is the second one of the ITI that, in my view, looks at short-lived information. So that could be used. And I think they share their estimates with people if they ask.
Yes. Yeah, I believed we used the ITIs at some point. I forget what for exactly. Maybe we looked into this or maybe not, but I do not believe that we were distinguishing between long-term and short-term. Maybe we should. And maybe we should look at return predictability over longer horizons versus shorter horizons where we condition on either type of the ITI measure. Yeah, that's a great idea. And yeah, I didn't think of the dark trading. That's a great observation, Andre. Thanks.
And I think your own, sorry, this is the last thing I'm gonna say, your own QuidRes metric
Yes.
probably picks up short-lived stuff more so than long-lived stuff.
Yes.
So all of that could be potentially correlated with this new metric. And
yes, you're right.
Okay, folks, unless there are more questions, we are going to start wrapping up. I wanted to thank Yash for getting up so early to join us and for the very interesting presentation. All of you for coming. And we will see each other in 2 weeks.
Thank you, Andre. Thank you, everyone, for all the comments and discussions. This is awesome.